Gautam Chhaocharia, Head of India Research at UBS, joins us. Gautam, good morning. Thank you for joining us. I guess if I look at the market behavior, the price action and the market action, there is every reason to get excited.
Good morning. Yeah, so we remain constructive in the markets, but the only thing is from near-term perspective, it has crossed our year-end Nifty target of 8,000, so which we haven't revised as of now. So for the near-term, the valuations are not. But again, this is purely from next 2-3 month perspective. While we remain very confident about the earnings trajectory, in fact, our view is that the earnings estimates for both 15 and 16 of 15% plus should be largely met, and that gives us confidence about still remaining constructive on markets.
Gautam, what's the sense that you're getting about this consolidation that you're talking about? Where do you think the market is going to find support? And do you think we could also sort of borderline go on to a corrective phase? Or is it just at best going to be a consolidation of about 100 odd points on the index?
It's difficult to quantify correction, but we're not looking for any meaningful correction as such. And consolidation means around current levels. X any global macro shock, obviously, and why we say that is purely because of the sharp run-up we have seen and the current levels. But again, you have to acknowledge that these are not euphoric valuations, and markets can overshoot on the upside also. But that will be more technical near term, on which you don't have a formal view as such. But fundamentally, it does look like possible scenario for consolidation, but no meaningful correction. So again, from a directional point of view, we still remain positive on markets from a 6-month, 1-year view.
Gautam, your Nifty target for year-end 2014 is 8,000. We are at 8150 on the Nifty. So according to your own analysis, are markets slightly stretched? Is it time to lock gains?
If you just look at short-term and on a fundamental basis, yes. But yet from a technical point of view, you always know markets can keep on overshooting, specifically as the outlook gets positive. Another thing which we have been talking about from the market's point of view, and which is slightly more year and a half kind of view, is about the broader rate cycle in India. So we have been talking about inflation moderation. We don't believe inflation to be structural in India, and we've recently written a piece arguing about possibly 200 basis point lower 10-year yields in less than 2 years for India. So that does give us confidence about fundamentally even arguing that there won't be any meaningful downside. But yeah, from purely from that construct of index target of 8,000 for the year end, it does look poised for consolidation around current levels.
Couple of economic data points as well, Gautam, expected during this week itself. When it comes to inflation, what's the trajectory that you at UBS are envisaging? Does it seem like inflation is going to now cool off, especially crude prices being of so much help and already cracked below the 100 mark?
Look, crude is a difficult one to forecast. So, but early in the year we had written that inflation in India is not structural. It is going to come down, and our forecast since early in this year has been 6% CPI for Jan 16, which is RBI's target. So we remain firm believers that inflation and specifically CPI and including food inflation, the trajectory is on the way down. And this is based on detailed analysis of both the macro as well as micro factors. Macro, both fiscal and monetary, and micro, our analysis on the drivers of food inflation for last 4-5 years, all suggest that it is definitely on the way down. So we're still sticking to our 6% CPI target for Jan 16. If we continue to see Brent crude moderating or remaining sub 100 levels, then there could be a positive surprise to those numbers, because all these numbers kind of resume Brent around 105 levels odd, which is what the street or RBI or us would have been looking at. So in that sense, the Brent could be a positive surprise to these estimates. And this entire inflation forecast and view is what is behind our view of 200 basis point lower rates over next year and a half.
Could we also see the Reserve Bank, Gautam, actually easing its policy, or is that not a possibility at least this year?
So our view remains that RBI will likely cut at about 25 basis points by the end of this fiscal, March 15 odd, and another 50 basis point in March 16. When you talk about 200 basis points lower rates, we're talking about the 10-year government paper yields. And what we've seen historically also is the market rates react first before the policy rate cycle begins. And RBI anyway would be lagging the market reaction because they would want a period of positive real rates from their perspective to revive financial savings and kill inflation expectations. The second thing is you would also remember that we are running right now a negative liquidity scenario in the short term. If we move to a surplus liquidity environment on a sustainable period, then you could have a scenario of RBI's repo rate moving to reverse repo rate as the effective policy rate, and that could itself mean another 100 basis point effective cut. So that also remains something which you have to look out for over the next year or 2 years.
At 8,000 on the Nifty, to your mind, if somebody is really scouting for some value and for some bargains after a 30% run-up, where are those bargains? Where is the risk-reward ratio still in your favor?
So we still think the risk-reward is very favorable for the financial sector, private sector, banks, wholesale-funded ones, as well as the NBFCs, all three parts. And specifically so with our view of the lower rates outlook for the next year and a half, and valuations still look very reasonable compared to long-term history, despite the run-up we have seen recently. So financials is definitely one space, and secondly, oil and gas space. Again, on earnings metrics and the classical EV/EBITDA multiples, these stocks have re-rated over last few months. But again, if you look at long-term history, there could be more upside potential still left in this space. So that these two are the sectors where we still think the risk-reward is reasonably attractive compared to the overall market and compared to their own history.
Gautam, when you say oil and gas, is it the oil marketing companies or E&P?
So at this current moment, our preference is for the E&P companies. We like ONGC as one of our top picks. So we have been believers in the marketing companies, but again, we do think that near-term upside can be capped because of current valuations. From a longer-term point of view, again, even that should be okay. We also like Reliance Industries. That also remains one of our preferred picks in the oil and gas space.
Gautam, in your recent report, you've talked about as to how, lower inflation is going to support a deposit growth, how beneficiary it is going to be for the banking space. But can you really paint the entire banking pack with one brush? That's PSUs included in the pack? Because they have a whole lot of concerns with the NPA.
Exactly. So obviously the impact will flow through in multiple forms. It will flow through in most importantly in the form of lower stress in the system. A very simplistic analysis we ran was 100 basis point lower rates in the system means 20% reduction in stressed assets. Everything else remaining same without assuming approvals, etc. and all that. So obviously the biggest delta will come from stressed assets coming off, and that will impact significantly the SOE banks also. But one of the things which we saw for SOE banks early last decade, where we saw significant bond book gains, and that drove significant re-rating for those banks, significant improvement in capital adequacy levels. That thing may be capped this time for SOE banks given the pension liabilities which they have. So that element of the upside will definitely be capped. And in that sense, the SOEs impact on SOEs will not be very different versus private banks, keeping in mind both lower credit cost as well as bond book gains. Non-bank financials obviously gain given their ALM and duration mismatch, in which they gain from lower rates of interest immediately.
So, would you stick to the SBI PNBs of the world, or would your list also draw down to Central Bank or a Bank of India, etc.?
So we don't have coverage of some of the smaller PSU banks, but yeah, among the coverage names, the top picks we like is PNB and SBI.
You've also talked about Realty and as to how lower rates, whenever that happens, is going to be a sentiment positive for the sector. Now, these are high beta names and huge debts on their balance sheet as well. Would it really be safe to venture into Realty names?
So that's not a preferred way to play this thesis also, because we also think as per our analysis the lower rates the impact on the NAVs of these companies will not be that significant given the physical market conditions versus what you'd intuitively believe. So I think from what I remember, the impact on NAVs could be anywhere from 4 to 8% of the lower rates scenario we're talking about. So it will be sentiment positive, but it's more critical to get the physical market outlook improving, of which obviously lower rates will indirectly impact at some stage, but the immediate impact on housing sales or on lease rentals picking up from lower rates may not be immediate. On the other hand, lower rates environment will obviously be a big catalyst for REITs, because one of the constraining factor for REITs to pick up would be high rates environment in India, which makes their yields not necessarily the best attractive option for investors.
Gautam, the latest global buzzword is e-commerce, and given the kind of valuation what a Flipkart or Amazon is commanding, do you think it makes sense to be a buyer in an Info Edge, maybe a Gati, or for that matter Just Dial?
We only have coverage of Info Edge, so we can comment on that. So Info Edge, you still have a buy, and we still like the name, so it will benefit by rising internet penetration as well as by rising trend of e-commerce. As a thematic, again, that's a space which is attracting a lot of investor attention globally, and our global client base are very keen on this space and are on the lookout for opportunities in India also.
It is at 900. A year ago it was at 300. Does it make sense to buy Info Edge even at 900?
So obviously the valuations are less attractive versus where they were at 300 levels or even at 600 levels. But a couple of things worth highlighting. One is the traction for its core business, both real estate and the job portal. They are also classical economic cycle beneficiaries. So compared to a year back, their core business fundamentals have also changed dramatically, just like you've seen other cyclical stocks run up. So you can justify the same angle for its core business. And secondly, for its the entire list of investments which it has in multiple small businesses, given the scale up we are seeing globally as well as in India, and specifically willingness to give higher valuations to that's also giving a lot of investors comfort in assigning some value to those investments, unlike a year back when most of the market was not willing to give any value to those investments.
Power utilities too, Gautam, and autos, you say, are beneficiaries of whenever the interest rate cycle turns. Explain to us the rationale and give us, of course, stock names that you like.
So power utilities, again, the big beneficiary will not necessarily be the regulated utilities, because it is largely a pass-through. But the non-regulated utilities who don't have interest costs as the pass-through elements, they will benefit at the margin by lower rates. But again, that's not a preferred space for us in the hierarchy of things from this thesis, and they will be lower down the order. But obviously, because the leverage is high, lower interest rates, if they're not passed on, they will benefit. So again, we do have a sell on Adani Power, but they could benefit from that. And NTPC and Power Grid will be lesser of beneficiaries because a lot of it is passed on.
So my next question certainly will bring a smile on your face, and I'm confident of this one because I'm going to be asking you on Bharti. And finally, Bharti is moving up. Do you think Bharti has some more headroom left?
We would believe so. So again, two simple logic behind that. One is we don't think Reliance Jio will act in a way which will be destabilizing for the market or play the irrational pricing game, because in our view that will not necessarily get its desired market share or subscriber base or profitability, specifically given the huge amount they've already invested. Keeping that in mind, even with a mild pickup in pricing environment, Bharti to us is also the classic deleveraging story. You have a utility like strong cash flows, which it will use to deleverage over the next 3 to 4 years, and that itself will give you reasonably high stock returns, even from current levels.
Gautam, but the challenge for Bharti is not Reliance Jio, it is Africa. And you know, the Africa business is very confusing. There is no real trend there. I know the worst is behind them, but the data activity or the ARPU in Africa has not really expanded exponentially.
Yeah, so again, our analyst view is again, we're not really building any optimism around Africa or any significant upside around Africa. As long as Africa stops being an overhang or a drag on cash flows, is still good enough for the stock to deliver good returns for investors, because the cash flows are still strong. For the India business, the cash flows are still strong. Africa is not needing any more cash flows to be invested there. So all the Indian cash flows can be gradually used to keep deleveraging, and that itself will drive significant stock returns from here.
Okay, Gautam, good chatting with you, and thanks as always for taking time out and speaking with us.